Celcius Holdings reported earnings this week, and results were a little bit disappointing if you actually just looked at the top line, and we're expecting this to be a company that continued to grow at 100% or so per year, the way that it has over the last few years. But digging a little bit further into the numbers, and the business is going really well, and one of the things that we're seeing is the impact of being a growth company that's making a physical good. And what happens is when you add retailers to the mix, they need to build inventory in their channels, distributors need to build inventory in their channels, and so there's this huge sell-in effect. That has an impact for a company like Celcius of driving a massive amount of revenue growth. But that sell-in is not the same as what we call sell-through, or sales to actual end customers who are going to drink your product. That is ultimately what really matters. It is their sell-through, but there can be ebbs and flows between those two numbers. And so what we're seeing is really strong sell-through, but the sell-in, as a lot of the retailers and distributors adjust the inventory levels that they have for Celcius, is really what's impacting the company's sales. So I'm going to dig into all these numbers. Hopefully this makes a little bit more sense throughout this video when you go through the revenue numbers, the inventory numbers, and then some of the numbers that they've reported from a sell-through perspective. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go straight to the report. This is the quarterly report, and I always want to point out that Celcius has one of the most hilarious investor relations websites out there. They put zero effort into this. The earnings report is just a PDF file on a WordPress site. So just an interesting dynamic for a very, very strong growth company that's built on a brand. But look at the high level numbers, and you see 37% growth year over year to $355.7 million. Earnings per share was up to 27 cents per share. Gross profit, $182.2 million. So all these numbers, really good for almost any company, but Celcius is trading for an extremely high multiple. So investors are expecting a lot of growth. That's why you look at this 37% number. You may be a little bit disappointed if you've been seeing their quarterly reports over the last few years. But we'll get into some of the other details. They go through this in a number of different ways. And what they said that there was a reduction in inventory on hand for their biggest distributor. That would be Pepsi in North America. And that had a $20 million impact on sales. In the first quarter of 2023, so last year, what we're comparing to, they had a buildup of approximately $25 million. So you actually add those two things together, and there was basically a change in inventory of $45 million when compared to the sell-through. That's just commenting on the North American business and specifically the Pepsi partnership. So what they say is ongoing inventory fluctuations may be expected in subsequent quarters because our largest distributor constitutes 62% of our total North American sales. So basically this is something that's going to happen again as retailers kind of fluctuate how much inventory they have, as the distributors fluctuate how much inventory they have. So expect this to be something on an ongoing basis where revenue is the revenue growth number is going to kind of be volatile over time. But what they said is retail sales of Celcius grew 72% in the first quarter of 2024. So that's probably a better indicator of what the end market demand, what the sell-through is to the channels, is this 72% growth number. Now, I don't necessarily know that sales are going to go up by 72% later this year, but you would have those channels filling up again as product is sold through the channel. The other thing that you want to see at Celcius is growth internationally. We're not seeing a lot of that yet, up 43% from a year ago, but just $16.2 million worth of sales. Expect this to be something that management talks a lot about throughout the rest of this year and into 2025, because it seems like with a lot of their recent announcements, this is really the focus that they're putting a lot of attention on, is expanding in international markets. Gross profit up 60%, so gross margin expanded to $182 million compared to $113.8 in the prior year quarter. The balance sheet is always worth looking at. No debt on the balance sheet for Celcius. They do have a significant amount of cash, $879.5 million worth of cash, included plus $200 million worth of receivables and another $200 million worth of inventory. So really solid balance sheet. They have all the cash that they need to execute their growth plans, especially when you consider this is a pretty capital light business model with their co-packers actually taking on a lot of the cost of building out equipment and actually building out and delivering inventory to customers. The other thing to look at would be SG&A expenses, operating expenses, up in the quarter and actually up 43.7%. So that's outpacing the growth in revenue. But like we talked about earlier, you have a 70% sell through. That's probably in line with what you would expect, getting a little bit of operating leverage there. Interest income, this is just interest on the cash that's sitting on the balance sheet. It was also almost $10 million. So that's an interesting addition to the company's net income, which was up to $77.8 million. Now, Celcius has always been a very expensive stock, but if you just take this net income number, multiply it by 4, so annualize it, you get a price to earnings multiple of 61, and that's without taking out any of the cash that's on the balance sheet. So very expensive multiple, but again, this is a company with sell-through in excess of 70%, recognized revenue growth of 37%. So I don't love paying this kind of price for stocks, but in the case of Celcius and its revenue growth, I think it's worth it to pay up for a company that's growing in this kind of way and this profitably. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, shares actually bounced back later in the week, and as I'm recording, shares are only down about 3% for the past month. So Celcius had a huge run up earlier this year. Obviously, investors are expecting a lot of growth, expecting a lot of increase in profitability, and they're starting to execute on that. But we are starting to get to the point where the growth numbers are not 100% per year. So now we're starting to question what sort of multiple should we be paying for a company like Celcius? And I think, to me, the answer is, what is your time horizon for a company like Celcius? I'm looking at, is this going to beat the market over the next 5 to 10 years? And a company growing at 30+%, if they can do that for a long period of time, that can be an extremely profitable investment, even if you're buying at a price to earnings multiple of 50 or 60. And that's where we are with Celcius right now. So I think there's still a lot of growth ahead. They haven't even scratched the potential that they have in international markets. There's a lot of ways to grow in US markets, better placement, which they have talked a lot about over the last couple of quarters. I think this is going to be much more than an energy drink. This is the one criticism that Celcius always gets is, well, once you take a huge share in the energy drink business, where are you going to go from there? But I don't think Celcius is just a comparison to Monster or Red Bull. This is going to be a drink that's going to be much more accessible to a lot more people. They've talked about this. The demographics are different. More women drink Celcius than drink traditional energy drinks. You're starting to see it at quick serve restaurants. You're starting to see it more prominently placed in grocery stores. That's not the kind of thing that you typically see with a Red Bull or a Monster. They're not going to put that next to a Pepsi. And so I think this is a very different company with very different total addressable market than a lot of those energy drink companies. That's why I think long-term the potential is much, much bigger than a lot of people think when you add in both the domestic or North American growth and the potential in international markets. And man, the profitability of this business is just so impressive because they don't have to build out the infrastructure to be either a distributor or the packer. They use co-packing relationships to actually get their products into customers' hands. So I still like where Celcius is right now. I would, of course, love to buy shares at a lower multiple, but that's not where we are today. If shares do pull back over the next few months, I'd be happy to buy at a 30, 40 times earnings multiple. That would be much more attractive than where we are today, but I don't see any fundamental flaws in the investment thesis long-term, and I'm happy to be a shareholder in this stock. What do you think about Celcius right now, though? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.